January 23rd, and this is Rich Siegel with ARQ Wealth Advisors, and it's time for a brief market update. Agenda-wise, we'll just touch on GDP, inflation, and then the market pullback, and then some market data. All right, first and foremost, fourth quarter GDP will be announced this coming week. Estimates look like they're in the range of 5 to 6% for the fourth quarter year over year, and over 5% for the full calendar year 2021. Those are big numbers. Prior to the pandemic and going back a couple of decades, the average GDP growth for the U.S. economy was around 2%. Inflation obviously has been a major problem. Latest reading for inflation was 7%, highest in about 40 years. And the reason for the high inflation is two reasons. One, supply chain disruptions. Obviously, when you shut down the entire economy and try to reopen it, it's not like a light switch. It will take time to rebuild inventories and support shipping, employees, etc. So there's anecdotal evidence this is already improving, and we expect this to be mostly resolved by the end of this year. The second reason inflation is such a large problem is because the Treasury has printed over 35% new U.S. dollars in the last couple of years. That's about triple what is normal, and it will take some time to absorb the extra M2 or cash in the system. You can't increase the money supply by 35% and dilute your currency and expect there not to be inflation. So this was done in order to save the economy from a deep depression. Looks like that's mostly worked. And again, it will take a few years at least to absorb the excess liquidity in the system. It is our contention that inflation will probably run somewhere in the 3 to 4% range by the end of the year. Not as optimistic as the Fed is telegraphing. As far as the market pullback, lots of turbulence, lots of volatility in recent weeks. My favorite quote from Tony Dwyer of Canaccord Genuity is, corrections are only natural, normal, and healthy until you're in the middle of one, and that's probably how most of you feel now. So pullbacks of 5% are pretty normal. They happen 3 to 4 times per year. We had a few in 2021. The technical definition of a correction is 10% or more. That happens about every year and a half or so. The interesting thing is that, according to Schwab, since 1974, the S&P has risen on average more than 8% just 1 month after a market correction bottom, and more than 24% a year later. So market timing is impossible for the most part. So we like to stay invested, limit the amount of downside by diversifying in other asset classes. And then when we do have a serious pullback of 10% or more, to rebalance portfolios, adding more stock, hopefully close to the bottom. Let's shift gears to some charts and valuations. The first chart we'll look at today is a chart of some U.S. indices for this year only, just 3 weeks. And you can see there's been some interesting developments. First and foremost, if you look here at the kind of violet colored line here. So U.S. large cap growth stocks, think Apple, Amazon, Facebook, etc. Nvidia, down 16% in 3 weeks. We've been calling for this for quite some time. Our thesis is kind of playing out here. We felt that large cap growth, technology specifically, has been quite overvalued for some time. The second line I'll show you is small cap stocks, down 11.4% in 3 weeks. Small caps generally are more volatile and higher risk than large cap stocks. So small cap stocks here as a total group, value and growth combined, down 11%. The S&P's done okay on a relative basis, down 7 2/3. And that's because a portion of the S&P is invested in value sectors. Think banks, energy companies, industrial companies, and basic materials. And finally, we see a gigantic divergence here in just 3-week time period. Value is pretty flat for the year-to-date number, whereas growth is pretty smashed here, down about 16%. Over the last year or two, we've been adding more to value over time and a little bit more to international to kind of divest from some of these high multiple, high risk, large cap tech companies. The second chart we'll look at today is kind of what's been working. So with inflation comes typically higher returns for commodities, and this is up 6% for this year. And by commodities, I'm not just referring to gold and silver. There's copper in there, and then some of the soft commodities, cotton, soybeans, etc., oil. And they tend to do pretty well in a pretty high inflationary environment. And then finally, again, the thesis is playing out. Foreign equities are outperforming U.S. equities by quite a bit. In fact, this year so far, while the S&P is down almost 8%, the NASDAQ's down, I think, 11, 12%. Emerging market stocks are actually positive. And then developed markets, that would be mostly Europe and Japan, down just 2%. Down here, we're talking about bonds. Bonds usually are flat to up when markets get hit like this, but they're not this year. And part of the reason why stocks are getting hit in the first place is because yields are going up. The market is starting to price in a new monetary policy regime. Jerome Powell and the Fed have been forecasting raising rates in 2023, 2024. And now with high inflation and a strong recovery in economic output, they're going to be pulling that forward. So by all accounts, this year, rates will be increased probably 3 to 4 times, and the market's already pricing that in stocks and bonds. So you can see here from this chart, long-term treasury bonds typically take it on the chin when rates go up, and at one point last week, down 6%. That's a pretty big drop in a couple of weeks. The U.S. aggregate bond index, down 1.77, municipal bonds down 138, and then what we call non-traditional investments down just under 1%. That would be low-risk, liquid alternative investments that don't carry interest rate sensitivity. But when everything is down, stocks and bonds, it's hard to make money anywhere, and therefore this category is slightly down as well. Finally, I thought this was a great chart to talk about. This is the VIX, the fear indicator. And typically over the long run, the VIX tends to trade in the teens, like 18 range or so. And you can see here going back about a year that these spikes are during little market pullbacks. So last year, several pullbacks, 5%, 4%, 4%, 5.5%, 6% here. So now we're at 29. And typically speaking, 29 is a good entry point for long-term investors. I'm not saying the market can't go down further, but what I am saying is that probably most of the damage here is done. We might bounce around here for a few months or so, but the bottom line is when the VIX is high, when the fear is high, that's when you want to buy, not when there's complacency. Lastly, just a couple of quick metrics to discuss. So the S&P is now trading at 19.5 times forward earnings. That's the lowest in a couple of years. So earnings keep going up, and prices went up last year, but they're down this year, so beginning to become more attractive. S&P growth stocks are still trading at high levels, 28 times earnings, and value is about 16.8 times earnings. So value remains more attractive than growth on a valuation basis. The Dow Jones, which is not so loaded up in tech stocks, is trading in the 18.8 range. And not to get into so much detail, but foreign equities specifically are trading at about 25 to 30% discount to U.S. stocks. And small caps, especially small cap value stocks, are quite attractive relative to large cap stocks. So to wrap up here, client portfolios, very diversified, U.S. stocks, foreign stocks, large cap, mid cap, small cap. We've added more value over the last several months. We hold bonds, mostly short duration, not as reliant on interest rates, and then non-traditional holdings to kind of smooth out the ride without any interest rate sensitivity. So with that, have a great day and a great rest of your weekend, and we'll see you soon.